Stop me if you've heard this one before. Europe is a museum. It's an economic wasteland. It's uninvestable. For the last 18 months, that has been the consensus on Wall Street. The narrative was simple. With Donald Trump back in the White House and his aggressive America First 2.0 trade policy slashing global supply chains, the Eurozone was supposed to collapse. We were told to short the euro, dump European equities, and retreat to the safety of the US dollar. The smart money said that between the energy crisis, the aging demographics, and the new US tariff wall, Germany was destined to become the new Japan, and the rest of the bloc would drown in debt. Well, I hope you didn't bet the farm on that prediction. Because the numbers just dropped this morning, and the dead man of Europe just sat up in the coffin. Today is January 31st, 2026. And the data coming out of Brussels isn't just surprising, it's a slap in the face to every bear on Wall Street. The euro area economy didn't shrink. It didn't stall. It grew. In the face of the most aggressive American trade war in history, Europe just posted a fourth quarter GDP expansion of 0.3%, beating every major analyst expectation from Bloomberg to Goldman Sachs. Germany is spending its way out of a coma. Spain is booming like it's 2005. And the ECB is sitting on steady rates while inflation melts away. But before you click away thinking, why do I care about Germany's Autobahn or Spanish hotels, listen to me very carefully. This resilience is about to trigger a massive repricing in the global markets. If the euro strengthens from here, it crushes the earnings of the S&P 500 companies you own. If Europe pivots to India, which they are doing right now, it isolates the US dollar in ways Washington didn't plan for. And with Trump now threatening a new conflict over Greenland, we are staring down the barrel of a volatility spike that could wipe out your 2025 gains in a week. The Atlantic gap is widening, and your portfolio is straddling the fault line. Let's peel this onion and find out where the money is going. To understand why this morning's news is so shocking, we have to rewind the clock to late 2024 and early 2025. When the US administration leveled those sweeping tariffs on European steel, luxury goods, and automotive parts, the goal was clear: force manufacturing back to the American Rust Belt. The logic was that Europe, stripped of cheap Russian gas and now cut off from the American consumer, would fold. We expected a triple-dip recession in Germany. We expected the euro to reach parity with the dollar, or worse, fall below it. But markets are complex beasts. They adapt. What we are seeing today, with this 0.3% growth across the Eurozone, is the result of a frantic, existential pivot. Europe realized that Uncle Sam isn't coming to save them. Uncle Sam is the one demanding protection money. So, how did they survive? First, look at the numbers released today. Analysts expected a meager 0.2% growth, basically a rounding error away from stagnation. Instead, the Eurozone maintained a solid 0.3% pace. That sounds small to an American ear used to 2% or 3% growth, but in a mature, trade war-battered economy, that is the difference between life and death. The standout star? Spain. The Spanish economy grew 0.8% in just 3 months. That is an annualized rate that rivals some emerging markets. While we were focused on the tech sector in California, Spain was quietly rebuilding its economy on a foundation of high-end tourism, rampant immigration filling labor shortages, and household consumption. But the real story, the one that matters for the geopolitical chessboard, is Germany. Germany has been the sick man of Europe for 3 years. Their industrial model was broken. But today's data shows Germany grew 0.3%, driven by household and government consumption. This is the signal we've been waiting for. The German consumer, historically terrified of spending, is finally opening their wallet. Why? Because the fear of inflation is gone. This matters to you because it proves that the US trade war didn't kill Europe, it forced them to evolve. And an evolved, independent Europe is a much more dangerous economic rival to the United States than a dependent one. If you're holding US stocks with heavy exposure to Europe, think McDonald's, Nike, Apple, Tesla, this is a double-edged sword. A stronger European consumer means they buy more iPhones. But a resilient Europe means the euro gets stronger against the dollar. And when the dollar weakens, or rather, when the euro rallies, those overseas profits look smaller when they are converted back to USD on the earnings report. We saw this in Q3 2025. Now, with this beat, expect Q1 2026 earnings guidance to be messy. Let's deep dive into Germany, because this is where the tectonic plates are shifting. For decades, under Merkel and then Scholz, Germany was obsessed with the Schwarz Null or the Black Zero, a balanced budget at all costs. They refused to borrow. They let their bridges rot and their military rust, all to keep the books balanced. It was an accountant's dream and an economist's nightmare. Enter Chancellor Friedrich Merz. Since taking the helm, we've seen a complete reversal of German economic dogma. The data released today confirms that government outlays on infrastructure and defense are driving this growth. Merz is essentially doing what the US did, spending his way out of the malaise. This spending splurge is hauling Germany out of the mud. We are seeing massive investments in the Bundeswehr and the energy grid. This isn't just about economics, it's about survival. With the US pulling back into isolationism, Germany realized it needs a military that works. This 0.3% growth is the first dividend of that investment. The German government predicts GDP will rise 1% in 2026. Again, that sounds modest, but remember, this is a country that narrowly avoided a triple-dip recession in 2025. This is a U-turn of epic proportions. But here is the catch, and here is where the risk lies for the global system. Business confidence in Germany is still muted. Why? Because while the government is spending, the export machine is still broken. The trade war with the US is hurting German manufacturing. BMW and Mercedes are feeling the pain of US tariffs. So, what is Germany doing? They are looking east. The report mentions a trade deal between Europe and India opening up new export avenues. This is crucial. If Germany replaces the American consumer with the Indian consumer, the global supply chain realigns. We are seeing a decoupling not just between the US and China, but potentially a soft decoupling between the US and Europe. If you are an investor in US heavy industry or logistics, you need to watch this. If European cargo ships stop heading to New York and start heading to Mumbai, the revenue of US ports and rail companies takes a hit. The trade volume across the Atlantic is the lifeblood of many US large-cap stocks. Merz is betting that he can slash bureaucracy and boost competitiveness before Trump's trade war escalates further. It's a race against time. Now, let's talk about the silent killer, inflation. In the US, we are still battling sticky inflation pockets. But in Europe? The dragon has been slain. According to the data, inflation is settling right around the European Central Bank's target of 2%. Spain is at 2.5%, down from 3%. Germany is hovering just above 2%. This allows the ECB to keep interest rates steady at 2%. Compare this to the Federal Reserve. If the US economy heats up or if Trump's tariffs cause domestic US inflation to spike again, the Fed might have to hold rates higher for longer, maybe 4% or 5%. Here is the arbitrage opportunity, or the trap, depending on your position. We have a divergence. Europe has low inflation and steady, low rates. The US has volatile inflation and potentially higher rates. Usually, money flows to the higher rates. But, if the US economy looks unstable due to political chaos or trade wars, and Europe looks like a safe harbor of stability with 2% inflation and 1% growth, we could see a massive capital flight out of the dollar and into the euro. The Bloomberg economics team just said, the upturn should reinforce the ECB's view that no further rate cuts are needed. This means the euro put is back in play. The euro has rallied recently, and today's growth data will add rocket fuel to that rally. What does a strong euro mean for you? 1. Commodities, a weaker dollar generally boosts commodity prices. Gold, silver, and oil might catch a bid here. 2. US exports, it makes US goods cheaper for Europeans to buy, which might offset some tariff pain, but the tariffs themselves block that benefit. 3. Tourism, if you're planning a vacation to Paris or Rome in summer 2026, it just got 10 to 15% more expensive. Book now. But there is a dark side to this inflation data. Look at Ireland. While the continent grows, Ireland slipped into a recession. Why? Ireland is the headquarters for US tech in Europe. When the US cracks down on tech or changes tax laws, Ireland sneezes. This is a canary in the coal mine for big tech. The regulatory environment in Europe is still hostile to American tech monopolies. If Ireland is shrinking, it means the tax/profit flow for companies like Google and Meta is being disrupted. We cannot finish this analysis without talking about the elephant in the room. The report explicitly mentions, it's too soon to sound the all-clear, though, following Trump's latest trade threats over Greenland. This is the geopolitical drama that keeps fund managers up at night. For those who forgot, the idea of the US buying Greenland was floated years ago. It was laughed at. But in 2026, with the race for rare earth minerals heating up against China, Greenland is strategic real estate. It seems the US administration is back at it, and this time, they are using trade threats as leverage. If Europe refuses to play ball, and Trump escalates tariffs again, all this 0.3% growth could vanish overnight. Imagine a scenario where the US puts a 25% universal tariff on all European goods until the Greenland deal is discussed. The German export engine would stall. The Spanish tourism industry would suffer as American travel dries up. This is the tail risk. The markets are pricing in a rational trade dispute. They are not pricing in a territorial acquisition dispute. So, what is the outlook for the rest of 2026? The bull case for Europe, Merz's infrastructure spending works. The trade deal with India replaces lost US volume. The ECB holds rates steady, and the euro climbs to $1.15 or $1.20. In this scenario, international stocks outperform the S&P 500 for the first time in 15 years. You should be diversifying into European industrials and defense contractors like Rheinmetall or Airbus. The bear case, the Greenland dispute escalates. The US weaponizes the dollar further. Europe's fragile growth fractures. Italy's debt becomes an issue again as rates stay at 2% but growth stalls. In this scenario, the dollar remains king, and you want to be in US treasuries and defensive US stocks. I think we are seeing a structural shift. Europe is becoming more insular and defensive. They are growing despite the US, not because of it. This means the correlation between the NYSE and the Frankfurt DAX is breaking. For the last 20 years, when the US sneezed, the world caught a cold. Now, the US is sneezing, and Europe is just putting on a jacket and going to work. So, how do you trade this? You're sitting in Chicago, London, or Toronto. What's the play? 1. Don't ignore international exposure. For a decade, the advice was buy US tech and sleep. That trade is getting crowded and risky with regulatory headwinds and trade wars. If Germany and Spain are growing their domestic economies, look at ETFs that track the Eurozone. They are currently undervalued compared to the US market. A 5% allocation there could be a hedge against US stagnation. 2. Watch the currency pairs. The euro to US dollar pair is the most critical chart to watch this month. If it breaks resistance, it confirms the European Renaissance thesis. If you hold a lot of cash, holding 100% USD is a risk when the US government is debasing the currency to pay for debts while Europe stabilizes. Diversify your cash holdings or hold hard assets. 3. The defense play. The German spending splurge on defense is real. This isn't a temporary blip. Europe is rearming. Defense stocks, both American companies selling to Europe and European native firms, are entering a secular bull market. Peace is great for humanity, but conflict and fear are great for the defense sector. 4. Avoid middlemen. Companies that rely on frictionless trade between the US and EU are in the kill zone. Shipping logistics, import-export firms, and retailers with thin margins relying on European luxury goods will get squeezed by tariffs. The data from January 31, 2026, tells us one thing clearly: the world is adapting to the new American isolationism faster than we thought. Europe was supposed to crumble. It didn't. It found new partners, it spent its own money, and it relied on its own people. This resilience is good for global stability, but it complicates the picture for the American investor. We can no longer assume the US dollar is the only game in town. The exorbitant privilege of the dollar is being tested by a euro that refuses to die. We are entering a period of economic trench warfare. It's not about blitzkrieg growth anymore, it's about attrition. Who can handle 2% rates longer? Who can handle trade barriers better? Right now, surprisingly, Europe is showing it has the stamina. Watch your portfolio. Watch the euro to US dollar cross. And most importantly, keep your eyes on Greenland. It sounds absurd, but in this timeline, the absurd has a funny habit of becoming reality. If you found value in this deep dive, smash that like button, it helps the algorithm find other investors trying to survive this trade war. Subscribe and hit the bell because when the ECB meets next week in Frankfurt, I'll be back to break down exactly what Lagarde says about the dollar. You've been watching Boss Economics World. Stay liquid.